Good afternoon, everyone, and welcome to the Atlanta Economic Club September webinar. It's been a really eventful summer. For those of you that have been a part of the club before and have attended our events in the past, welcome back. If this is your first event, I hope you find it really worthwhile. Decide to come back for more. Really excited about today's topic. Always trying to find relevant content for our events at the AEC, and today's discussion on labor force trends should be no different. I know Aaron has a lot in store that he can't wait to share. Before we kick things off, I just wanted to take a few minutes to update everybody on the 2022-23 program. Very happy to announce that the AEC is going to be resuming our in-person luncheons throughout part of this year's program. I don't think we're at the point where we can do this every month, but our goal is to at least get together a few times during the course of the year so that we can see each other face to face and sort of reduce our reliance on these Zoom calls. Been a long time since our last in-person event back in early 2020, but the board met over the summer. We decided to hold 4 in-person events this year. We're going to have 2 in the fall, 2 in the spring. Just a couple of details on the in-person events before we dig into today's program. While we're ready to resume in person, the Federal Reserve really isn't quite there yet in their policy towards outside guests. So what that means is that we're going to start looking at alternate locations. So in the fall, we're going to alternate our meetings between Cox Automotive's headquarters in Sandy Springs and in Oglethorpe University. Okay, we've had events in the past at Cox campus. In fact, they've been some of our best events. I'm really looking forward to going back to that campus and visiting again. Our first in-person event is going to be next month. So the October session that is scheduled for the 19th is going to be at Cox's campus in Sandy Springs. And then we'll have a second event later in the fall at Oglethorpe University. With the return of the in-person events, we're going to be starting back up our annual memberships for our members. So, I mean, if you guys recall, we sort of suspended all individual memberships during the pandemic just because we didn't feel right charging money for people to attend webinars. As we go back into in-person events, we're going to be resuming these annual memberships going forward. The annual memberships, keep in mind, they allow us to cover our own costs for putting on these events, and they also go a really long way to helping us support the scholarship that we provide each year. We still have some details to work out about the fee structure, especially given the reduced schedule of events. I mean, we're not doing 9 in-person events anymore. And so the board and I we're just sort of hammering out all the details. You can expect to see an email over the next couple of weeks with all the nuts and bolts of how the membership structure is going to work and how sort of attending the luncheons is going to work going forward. But again, really, really happy that we're going to be getting back in person this upcoming year. I miss you guys. It's been a really long time. And a lot of this, the benefit that comes with this club comes with the networking with other professionals in the economics profession. So I'd be really happy to get that up and running again. So with all that out of the way, I'd like to introduce today's speaker, Aaron Terrazas. I've followed Aaron's work quite a bit over the last few years. For a little while, me and him, we overlapped in the transportation industry before I went over into commercial real estate, and he took his current position over at Glassdoor. Aaron Terrazas is the chief economist at Glassdoor, the world's leading platform for workplace reviews and salary insights. Prior to that, he was the director of economic research at Convoy, which is a trucking marketplace startup company. And he also worked at the real estate website Zillow. Started his career as an economist with the U.S. Treasurer's Office of Economic Policy, educated at Georgetown University and Johns Hopkins University. So without further ado, I'll turn it over to you, Aaron, and take it away.
Thanks for that introduction, Ibrahim, and I will share my slides here. I think every time I hear the bio get longer, I'm just reminded of kind of the years passing and kind of it's both nice and a little bit sad how time flies. So again, thanks Ibrahim for the introduction, and thank all of you for taking time out of your afternoon to join. It's great to see at least a few familiar faces in the audience. I know as we're all transitioning back from kind of being completely remote to doing more and more in person, kind of the opportunity to do this remote. I'm not in Atlanta. It is kind of a nice thrill. So I've been in this job, as you said, for just about 3 months, 3 months this week. And this is actually my first in-person, my first external presentation. So I hope you all will be understanding if I am a little bit rusty in my talk. This is my first time doing this on behalf of Glassdoor. One person who is never rusty, however, is Glassdoor's general counsel, Annie Khalid. So, I'm throwing up this slide. If I've learned anything in my career as an industry economist, it is never cross your legal team. Y'all are familiar with this language, I'm sure. Basically, it says that nothing I say can get me into trouble, which is obviously how this all works. With that, kind of having done that, let me get into the content. I put kind of exit, voice, and loyalty in the post-pandemic workplace on the title slide. That's really just a small part of what I want to talk about. And here is kind of a little bit of what I plan on covering. First, I was going to tell you a little bit about kind of my team and what we do. Research is a team sport in industry, as I'm sure you all are familiar. It is never kind of, or rarely, just kind of one person doing this in isolation. I'll highlight some of the recent research from my team, and then I was going to finally conclude on some of the ongoing research themes that we are starting to dig into. So with that, a little bit about Glassdoor. I'm sure, at least some of you, hopefully most of you are familiar with Glassdoor. As Ibrahim said in the intro, Glassdoor is the worldwide leader in insights about jobs and companies. We attract over 60 million unique users every month who are looking for information, looking to find a job and a company they love. We launched back in 2007, so about 15 years ago, by three gentlemen, kind of Robert Homan, Rich Barton, and Tim Bessie. Early on, people called us the Zillow for salaries. That's not a coincidence. Kind of Rich, one of our co-founders, was also a co-founder of Zillow. So this is basically the standard user interface that you will find on Glassdoor. If you haven't kind of checked it out, I encourage you to. 15 years in, as I said, kind of it's been around quite a good amount of time at this point. We are much more than just a place where people go to check on kind of what your salary kind of should or might be. Last year in 2021, we acquired a company called Fishbowl, which is a social media platform for knowledge workers to share kind of experiences in a more candid and trustworthy kind of exchange setting. Glassdoor is kind of very famous for reviews, or people can leave kind of one-time, moment-in-time reviews of their experience at a workplace. Fishbowl is more interactive, and engaging. Kind of people can kind of respond and reply. Kind of that said, reviews are still kind of our bread and butter. About 51% of reviews do mention salary. And so kind of people continue to contribute salary information. It's not just kind of salary, they can rate benefits, they can kind of rate CEOs. For a long time, we ran kind of a top rated CEOs in the country. Recently pivoted away from that in recognition that when it comes to what makes a place a good workplace, the reality is kind of less and less it has to do with CEO and more to do with kind of middle managers and your direct team. That's ultimately, I think, kind of what makes a workplace either kind of a good experience or a not so good experience for workers. So our research group was established back in 2015. So almost kind of about 8 years into the existence of the company, by Andrew Chamberlain, who I'm sure some of you may know. He stepped out of the world about 2 years ago. But he is really kind of the person who established this mission, what we do at Glassdoor Economic Research. So the idea is that we are a think tank inside of Glassdoor. And as someone who started my career at an actual kind of nonpartisan think tank in the DC area, I recognize how special that is, the degree to which kind of the executive team and leadership really respect kind of and value that independent perspective that economists bring. One of my mind always goes back to early in my career as an economist. One of my mentors at the Treasury Department told me that the purpose of economists, at least in the federal government, is to be the conscience of the organizations we serve. And so I take that mission very seriously. And that's one of the things that really attracted me to Glassdoor, is kind of the independence and deference that we are afforded internally. So kind of these 4 bullet points of our mission, really to test the external validity of our data and our products. Do they make sense? Are they aligned with all of the other information that is out there about the labor market, about wage trends? We produce studies, we do research, and that is the single biggest portion of what we do that offer compelling insights to companies and job seekers. Those are the two sides of our marketplace: companies looking to hire and kind of job seekers or people kind of in current jobs looking for information. A big part of our team's work is to provide useful data and useful information to them. Third, we are internal experts. We deepen Glassdoor's understanding of employee experience, workplace satisfaction, and obviously kind of the labor market. This goes on to inform product development. This goes on to inform sales decisions and marketing decisions and executive decisions. To be that source of internal expertise, which any economist who works in industry, to some degree, you serve that function. And finally, kind of the fourth purpose really is to be kind of a technical innovation center. Kind of where can we bring the Economist toolkit beyond? Obviously we have a very large data science and research science team that does kind of a lot of testing and a lot of kind of product development. But where can we bring the Economist toolkit to inform some of these decisions and some of these product goals? And that is our website. I encourage you to check it out after, or kind of as you're browsing alongside. So in practice, what does this mean? This is the type of stuff we do. A link to some of the studies the team has done over the years, kind of blog posts and PR campaigns, awards. Our team is at the foundation of Glassdoor's Best Places to Work initiative, which is an annual kind of ranking, an annual list that we produce. We produced it for 15 years. And then you see on the right there some of the skill sets that are involved. There are really these three overlapping types of skills that most economists who work day to day really rely on, some combination of economics and economic theory, data savvy and data work, and then obviously communication and presentation and writing and so forth. These effectively are the three goal families. I won't spend too much time on it, but that this is another way to visualize the types of work that our team does. And when I mention the team, this is the team. And as I talk about the research, I really want to be grateful for all of the things that they do. It is a small but powerful team. Daniel, our lead economist, based in New York, has been on the team for 5+ years. Lauren, our London-based economist, has been on the team for about a year. Glassdoor is an international brand, so we collect data and insights on companies around the world. The UK is one of our biggest markets outside of the United States. Obviously, the appeal of the English language and the ease of use makes that naturally a large market. And then Richard, one of our economists, also has been producing a lot of work over the past year. So I'm really grateful for all the stuff they do. And I guess I'll end this introduction section with just the caveat that this is the team and the organization and the structure and the scope of work that I inherited 3 months ago. And so part of my job, being relatively new in this role, is to think about if this is the right set of things for our team to be working on. And that's really where I spent the bulk of my time since starting. Where can our team and our team's toolkit have the largest impact for Glassdoor as a company, largest impact for our customers on both sides of our marketplace. So this is what we've done, not necessarily what we will do moving forward. And part of the fun is thinking about that right mix of past and future. So the next couple of minutes, I figured I would walk through some of the types of research we've done over the past year, and hopefully this will spark interest. Happy to answer any questions that come up. For when possible, I've thrown in links and high-level findings, but I encourage you to dig in further. So pay gaps and gender pay gaps has been a big focus of our research, part of Glassdoor's corporate values is kind of making helping companies ensure that their workforces are diverse, that their pay is equitable, and practices are inclusive. So we have spent a number of years researching gender pay gaps. Obviously, this is a classic problem that has been extensively researched in the economic literature. This is an approach that Andrew did a little over a year ago, looking at over close to 500,000 Glassdoor salary reports, and kind of some of the headline findings were that occupation and industry controls do add a lot of information, particularly kind of job titles. He found had a big impact. One of the unique features of our data set is that we do have a self-reported years of relevant experience. I know, when I've looked at this question using publicly available data sets, that is such a tricky hedonic control to include in any wage hedonic. Obviously, many of the public data sets have, education level and age. It is rare that you have something like graduation year or actual kind of job relevant experience. And that's what we ask. Obviously, it's self-reported, and you need some caution there. But I think kind of the improvements are obvious over crude proxy like age. Increasingly, careers are nonlinear. People don't necessarily kind of graduate and start working on a single career path. People change careers, they pivot, and so more and more there should be this discrepancy between pure age and relevant workplace experience. So this is kind of research that Andrew did, and I think is still kind of highly relevant. Internally at Glassdoor, one of the things that our team is responsible for is conducting analyses of Glassdoor's own internal pay equity to ensure that there are no gender or race ethnicity gaps in Glassdoor's kind of pay practices. This is kind of part of our internally focused work, and Glassdoor does publish a pay equity report on our website if that's something kind of you're interested in checking out. So that's kind of one piece of research. Another kind of second piece of research, this is from Daniel, that I wanted to highlight, is salary aspirations. So we were able to look at user interaction on our website, look at the kind of the estimated salary for the types of jobs that they are currently in versus what they are exploring and considering, and you can kind of see what kind of pay bump are they looking for in their next role. This was conducted in March, so it's a little bit stale. Obviously, kind of the labor market has changed a lot since March, but you do see kind of reduced aspirations in the depths of the pandemic, and then kind of certainly starting to rebound in the 2 years since. Kind of this clickstream data, kind of how users interact, with our website. Such a fascinating space. There's a really rich literature on the degree to which kind of those actions and interactions with our website are shaped by product decisions, and we do attempt to control for product design implementation and stuff like that. Another kind of set of research is hourly wages. So this is an analysis that Daniel also put together, looking at reported hourly wage for restaurant, bar, and food service workers, and it really kind of shows the evolution of that floor or the lower bound on food service worker wages, as kind of there has been a nationwide push for a higher minimum wage. You can see how the modal kind of hourly wage reported for these workers has shifted from $8 an hour in 2015. And now in 2022, kind of modal is kind of $15 an hour, which is, that kind of in many states and some parts of the country is now kind of the minimum wage. I think kind of one of our big lessons kind of from here is that, we constantly debate this question, the degree to which kind of the self-reported data that we receive from our users are reflective kind of general labor market trends. Anytime you have kind of that self-reported behavior on any platform, you worry about bias. When I started, kind of this and kind of a couple other charts really gave me the conviction, helped me kind of build conviction that our data are representative of the broader labor market, and kind of helped ease my concerns about bias there. Another kind of area that we have researched is kind of the impact and interest in remote work. Obviously, this has been the major transformation over the past few years in the labor market, and there are so many questions out there. To the degree to which this will be an enduring trend versus revert somewhat back to pre-pandemic norms, or to what degree will this impact teams and companies and worker satisfaction and all of those downstream effects. Not to mention kind of the commercial real estate and local business activity data that kind of Ibrahim kind of probably looks at. So this was kind of looking at kind of internships in particular, and it found that kind of what is the sentiment for that is kind of conveyed in reviews about remote versus full-time in-person internships. And kind of really used some cool techniques to extract kind of that sentiment, characterize reviews as as positive or negative. And you do see kind of it is suggestive of some of the challenges that remote employees, and particularly remote interns, kind of have. So obviously this is an ongoing extensive debate with kind of a lot of new research coming out. This is kind of one more piece of evidence to hopefully contribute to that conversation. This is, I want to highlight a piece of research that Richard on my team produced just a month or two ago. Kind of obviously generational trends are a constant topic of debate in for recruiters, for executives. Kind of what do shifting preferences among older, middle-aged, younger workers. Millennials are now middle-aged, and so Gen Z are kind of the youngest generation of workers. So Richard looked at kind of the types of companies that kind of Gen Z, so workers, who are, the oldest Gen Z are in their early 20s. I think they're kind of about 25 at this point. So, so he looked at kind of the types of companies where they have the highest job satisfaction. And, this is the list of companies that came out of that research. There was some interesting data in there that in general, kind of Gen Z tend to be more satisfied at larger companies. It's hard to say whether or not that is a function of kind of the kind of the opportunity sets that's available to them, or whether or not that reflects kind of a risk preference. Anyone who came of age over the past 2 years into the labor market in 2019, 2020, 2021 has had a unique set of foundational experiences in the labor market, kind of both kind of good in that kind of it's been a very tight labor market, but also kind of volatility in smaller companies facing a lot of challenges. So, you have to wonder kind of with so much research out there about the long-term effects of our foundational economic and labor market experiences, to what degree will this have lasting effects on Gen Z's attitudes about risk and kind of work-life balance and workplace satisfaction. The highest rated companies for Gen Z do tend to be, in general, some of these large companies. Some of these were a little bit surprising to me. General Motors, kind of Northrop Grumman, IBM. They're not kind of typically kind of the, perhaps I'm reflecting my bias, kind of the places where your mind automatically goes to when you think of kind of the types of places that attract kind of the youngest workers. But it seems to be where they are very happy. This kind of piece of research is something that Lauren kind of did for our UK blog, and it looked at kind of the propensity to apply elsewhere among hybrid versus non-hybrid workers, and kind of breaks it out by sector. And so she found that hybrid workers were less likely to apply to jobs elsewhere. Again, kind of a large part of what my team deals with is trying to get at these causal claims with imperfect data. You never quite have as much data as you wish you had, but kind of trying to find multiple sources of suggested evidence. And so this is kind of a cool piece that she did. The last two slides are two topics that are particularly near and dear to my heart. Kind of starting to get into more of the research that I've started to advocate during the past 3 months. And this one looks at the hidden productivity cost of churn. It basically looks at it's a VAR impulse response selection, kind of looking at the relationship between kind of labor productivity and quits. And so what happens to labor productivity in the quarters? It's quarterly data after a surge in the quit, after shock to the quits rate. I think anyone who's been in the workplace during the Great Resignation has an intuitive sense that labor churn is massively disruptive, particularly in knowledge sectors and for service workers, less so perhaps in manufacturing where processes are standardized. But obviously there is the cost associated with recruiting and hiring a new candidate, but there's also the cost in terms of lost team time when it comes to interviewing and finding a new candidate. There is the cost, in terms of onboarding new employees. You talk to recruiters and they say it takes anywhere from 6 to 12 months before they expect a new hire to be fully onboarded and fully productive. And that's kind of at tech companies, kind of at large tech companies where they should have to some degree standardized processes. Just kind of a very concrete example of this. Kind of last week I was on a flight and we were arriving to the gate, and I they were taking a little bit longer than expected at the gate, and I overheard the flight attendants talking about how the gate agents, the people who drive kind of the bridges connecting the terminal to the airplane, there were so many. The flight attendants were saying that there were so many new gate agents that they were so slow to learn, and they said something kind of on a positive note, saying we've all been learning at some point in our careers. But I think for me, this really drove home the point. Kind of that was a very concrete productivity impact of churn. Someone had quit their job as a gate agent, and because of that, my flight was delayed 5-10 minutes. Getting off the plane. You aggregate that up over the full economy, and so I think kind of this question of what has been the impact of the Great Resignation on labor productivity is something that probably doesn't get enough attention, and something that I'm certainly thinking a lot about. Kind of not to spend too much time on this chart, but you think about the downstream effects of a negative productivity shock on the economy. Kind of it should be inflationary, and so you have to wonder like how much of what we're seeing. Obviously, there are many forces kind of behind kind of the recent surge in inflation. Supply chains and kind of the labor market, obviously, but the labor productivity is probably somewhere in there. The final piece of research from my team that I wanted to share was this kind of blog post which is linked there, which was titled "Satisfied Workers Stay," and basically looks at the relationship between current job satisfaction and propensity to click on a job elsewhere. So click as a proxy for apply. And intuitively there should be this relationship, and fortunately we did find it, that people who are happier in their current jobs are less likely to be looking elsewhere. And going back to what we were just talking about with the downstream consequences of labor churn, at the broader macroeconomic level, but also at the individual firm level and how disruptive that is for individual companies. Kind of for me, this was really telling about how important it is to kind of keep a pulse on employee satisfaction, because when employees are not satisfied, they are looking elsewhere. Kind of the tagline that we associated with this piece of research was that you can't stop your employees' wandering eye, but you can reduce the odds that they'll click apply, which was kind of a clever phrasing. Perhaps not surprising, kind of this relationship is less pronounced in public sector than in kind of sectors like professional technical services or healthcare. So that is kind of the scope of kind of past research that I was going to cover. I guess I was going to end just touching on some of the ongoing research themes, and kind of once we get into the Q&A, I'm happy to answer any questions you have about kind of those pieces of research. Again, I didn't do all of it, so I'm not kind of deeply familiar with all of the methodologies, particularly in some of the older stuff, but some of the newer stuff I'm happy to dive into. So this is kind of where we're thinking about looking out toward the next year. Obviously, kind of real-time wage compensation trends, not just at the aggregate level, but kind of drilling down into the industry, occupation, kind of sub-national level. This is kind of really important given where we are as an economy. It's so important for so many decisions out there. as we've worked with our Lauren outside the UK, it is kind of shocking. I think we're all probably, anyone who's worked with data internationally knows how grateful we should be in the United States to have such kind of rich, kind of close to real-time public data that is not typically available in almost in most, I venture, kind of just about any other country. So looking at kind of UK or France or Germany, kind of real-time wage indices where it is not unusual for data to be lagged by 3-4 months, where kind of subnational data are largely unheard of. So that's something I'm really excited about. Kind of a sub-theme within here is how firms and workers are navigating kind of right now the trade-off between cash comp and benefits in an inflationary environment. And obviously there is kind of a big tug of war happening, between kind of workers feeling the pinch of inflation and companies trying to control costs. To what degree will we start seeing kind of more non-cash compensation when it comes to benefits? To what degree will we start to put a price on amenities? Perhaps the amenity of availability to work remotely. That is something kind of we are continuing to research. Kind of more when it comes to kind of the core product. A topic that kind of we're all very interested in is kind of looking at kind of career pathways, and career pathways not just kind of in the traditional kind of ladder kind of sense, but like what are people looking at, and kind of how can we associate different occupations based on the next step that people want to make in their careers, using our web interaction data to help kind of identify those career pathways. Third kind of research stream is quantifying corporate culture. Kind of there are so many kind of really cool advances in NLP and topic modeling. Glassdoor has such a rich, long history of this text data. And we have a team outside my team that specializes in NLP and kind of is doing all sorts of cool innovations on characterizing kind of that text. So that's something I'm really excited about leveraging more as well. And then kind of finally to kind of end where I began, kind of this title, which is exit, voice, and loyalty in the post-pandemic workplace. I think about the long history of Glassdoor, kind of me coming into this role 15 years in. Even before Glassdoor, kind of the jobs market was one of the first markets to go online. You think back to monster.com back, I think it was 1996. And so this is, a really kind of, in some ways, a really established space, but it's also changing really quickly. The pandemic really transformed kind of what I call the last mile of the job matching process, the interview and offer stage. Suddenly with remote interviewing becoming more common, that interview and exploration and matching process is a lot less obtrusive, a lot less costly, a lot more frictionless than it used to be. I remember, when I was working in DC and interviewing for my job at Zillow, kind of having to surreptitiously take a sick day and fly across the country to interview for that. That was a big friction on my part. Now kind of people working remotely kind of can kind of interview a lot less obtrusively. All in all, for a given level of job satisfaction, the costs of exit have come sharply down. So, any quit is obviously kind of this combination of push and pull forces. But I think lower frictions, this lower transition cost is an unexplored reason that, for the great resignation that we've seen over the past 2 years. And, in my mind, there's just kind of, there's been so much investment over really 3 decades now, to make that matching process easier. I think there has not been enough investment, enough attention in kind of reducing the costs to stay, to voice and employee voice, and helping kind of helping give people an outlet to express dissatisfaction without outright quitting. And that's really kind of where my mind is at when I think about kind of the future of our research over the next couple of quarters to hopefully years. So with that, that's all the material I prepared. I'm happy to take questions or kind of go into other topics if you have. Ibrahim, I can hand it back to you.
Thanks, Aaron. That was amazing stuff. And I suspect as you go forward in this job, there's there's going to be no shortage of just kind of interesting topics to tackle as we as we start looking at sort of the post-pandemic environment. And so I just wanted to start. Um, my general selfish focus here largely revolves around like returning to office, remote work, and attitudes there. I was wondering if you just had thoughts on sort of the role the broader economic environment plays towards these attitudes. Like, I mean, there's a running theory that because the labor market is as strong as it is, um, people don't have the same sort of fear of being laid off or not being able to find alternative sources of employment in the case that they get fired. And so remote working in that kind of environment is very attractive. Um, you know, the thought being that like if the economy turns south or if there's a weakening in the labor market, then all of a sudden it becomes a lot more important to get that face time with your boss or what have you. So I was just curious as to like what your thoughts were on the just like the broader business cycle plays in some of these attitudes.
Yeah, I mean, I think, when you look at where the labor market has softened most, it does tend to be in those kind of knowledge sectors, kind of tech, finance, um, kind of those are the same sectors that kind of have seen the largest pivot to remote work. And so, the kind of when we talk about kind of the future of remote work, I think you talk to most people, and very few people will think that we're going kind of back to those sectors going completely into the office. But it does seem like the pendulum is temporarily shifting. Now, what I worry, or not worry about, but what I suspect is likely to play out is we've effectively seen, for those sectors that rely on most work, kind of a globalization of the workplace, and that kind of decreases kind of bargaining power for workers who are not the most productive, and increases bargaining power for the workers who are most productive. Kind of there are these nonlinear impacts, just like globalization kind of created opportunities for kind of the most competitive, internationally competitive companies, and kind of made the situation more difficult for companies that were less competitive. It's going to be the same impact for workers. So you're going to have kind of workers who have strong leverage, strong negotiating power because of their unique skill sets or unique talents, who, for whom this is not going to be an issue, and then kind of other workers who have less unique talents, who are going to face more pressure to be back in the office. Kind of Nick Bloom and kind of a bunch of others at Stanford have done a lot of research on kind of how much workers value the ability to stay home, and not kind of commute, not go into the office, and to what degree which side of the market absorbs that surplus.
So a couple questions here from the audience. One question is just talking about like the future for wages and what that looks like going forward. So with economic forecasting, do you anticipate we'll see a decrease in wages, and if so, at what point?
Yeah, I mean, so we currently don't produce kind of a quantitative forecast for kind of wage growth. That that's something we're certainly thinking about. Obviously, as a publicly traded company, we have to be cautious about kind of the degree to which we make forward-looking statements about things like that. So without going into any specifics, you think about the underlying forces kind of shaping wage growth, kind of competition, kind of for workers, kind of long-term kind of supply availability. My instinct is that we see more of a kind of bifurcated kind of labor market when it comes to wage growth over the coming year, with less pressure at the top of the market, or among skilled sectors, and continued pressure for frontline kind of in-person work, kind of what you might be called blue-collar work.
Yep. So another question from the audience, just going back to the slide you went over earlier about compensation gaps and things like that. So just what non-based compensation adds to the compensation gap? So just like some examples of what might contribute to that.
Yeah. Again, this is kind of was Andrew's original research, and so we do collect data on kind of equity compensation to the degree that matters, and but beyond that, I would kind of suggest kind of taking a look at the link in there and then reaching out if you have any questions. So.
Yep. And then is there any data that you guys have collected on turnover following some of the return to work mandates? I imagine this is probably an area of future a future resource, right? Like I mean, when I think of work mandates, they kind of come in waves. There's initial mandates that occurred
Yeah,
sort of shortly after the vaccines were rolled out. Maybe another push in Labor Day last year. Currently there's a push I would say going on right now to get workers back in there. I'm just wondering if you have any data that collects that sort of stuff on the turnover that emerges after these mandates are pushed.
yeah. The closest kind of we have to that is kind of Lauren's research that I showed about kind of hybrid workers kind of less likely to churn. We have kind of spent some time trying to identify companies that are in different stages of return to office. The reality is relatively few companies are pure one or the other. Most companies have some mix of workers who are and kind of continue to be in person and workers who are able to do work remote. It's not the same for every skill level, every team. And so that heterogeneity is actually kind of quite difficult to grapple with. And really you need kind of that individual level data, which is why we tend to look at kind of a person's role, or probability to click on a job elsewhere as a function of a person's role and the characteristics of that role.
That's right. I mean, I would imagine a lot of it largely hinges on the kind of work that they're doing in the companies and what the potential options are uh, for alternative sources of employment and things like
Right.
that. Yes, I agree with you there as far as that's concerned. I just had a sort of a separate question about your views on how these firms are viewing like the return to work and return to the office. I mean, I think the initial feeling, after the first year of the pandemic, is that they couldn't wait to get people back into the office to reinstate company culture. At least that was, if you talk to financial firms or in certain industries, there was a real desire to get people back into the office. But the flip side of that is that like allowing for remote work broadens the labor pool that you can attract, right? So there's
Yeah.
an inherent tension there that from a firm's perspective that you want to instill company culture, but
Yeah.
also you're able to take advantage of being able to pull top talent from anywhere. And so just curious on your views on that, or if there's any data that you guys are collecting on that sort of thing. And I mean, the data I'm sure is difficult to come by as far as that's concerned.
No, yeah, it's a really good question. I think I'd make 2 points. First, kind of most survey data suggests that kind of a lot of workers kind of do appreciate kind of the ability to remote work, and some of the sentiment you'll see in kind of the fishbowl or kind of like the kind of the text kind of conversations that pop up when these kind of policies get announced is that there's critiques that the people kind of making decisions and kind of advocating remote work are the ones who kind of traditionally benefit, or advocating in-person work are the ones who kind of benefit and are most able to engage in in-person work. Parents kind of love the option to remote work, and so kind of older workers as well, kind of who may still have fears about kind of the virus, kind of love kind of the option to remote work. So I think ultimately kind of this kind of touches on two really kind of or a really big debate and kind of one fascinating kind of technical question. Kind of the big debate is really about workplace democracy and to what degree kind of are decisions in the workplace going to be top down versus bottom up. But I think the long-term drift has been toward more workplace democracy, but that is a messy process. You talk to any CEO who has ever engaged in a town hall conversation, that is a terrifying, fraught experience for them. Does it have to be that? Is there a way to channel kind of employee sentiment, to kind of to be a little bit more structured and kind of productive? I think the fascinating kind of technical question that you raised, which is something I hinted at in my reasoning, is quantifying culture. This is not something that kind of economists as a profession have, tried kind of to do very much, but I think it's going to be important in the context of kind of workplace, firm, and industrial organization studies. How do we begin to put a number on culture, and why care about it? Presumably the assumption there is that it matters for productivity. Does it? And I think that's kind of some of the questions that, certainly my team, but a lot of other researchers are going to be asking and trying to figure out over the coming years.
Well, sure. I mean, certainly from an outsider's perspective, looking in at some of these firms, it's important to understand. But even within these firms, like my company struggles with the same sort of thing. Like they're in the middle of another sort of push to return to work and return to the office, and there's a general sentiment that company culture is a good thing, but there's not a great way of quantifying exactly how good, and is it worth what's it worth sort of trading off when thinking about it. Again, especially given the context that like allowing more flexible work really does broaden your pool of talent, and it also there's a direct cost associated to bringing people into the office. Like there's a very tangible cost of just like having enough office space to have all these employees. But you're right. I think that on the other end, they don't do a great job of quantifying sort of what the benefits of that stuff is. So I just like I have. I'm trying to think of the best way to phrase this, but I essentially I just have one last question. We head off, and again, it's more about this idea of returning to the workplace and sort of the interest there. My underlying feeling is that like there's probably a lot of people's interactions with remote work and the way that the way that they react to it largely hinge on like these firms' ability to do it properly. So when thinking about these companies, there's some that sort of going into the pandemic were probably already going down that path of offering more remote work, but there were others that were really forced into it. That everybody was sent home and they just kind of had to do it, and it's a big culture shock for a company like that. And I was wondering if you guys were heading down that path of understanding like what kind of companies typically do well in those kind of environments, which ones don't do well. I can think about just my own previous employment history. And I know that some of the companies I used to work to didn't handle the transition very well just because it's very difficult.
Yeah.
And I know there are others that probably did it very well. So just again, I don't necessarily think that you have research on hand that already tackles this sort of stuff, but I'm just wondering if you guys are headed down that path, or if it's something that you're trying to collect data on.
No, certainly. I mean, I think kind of you're right. This is a fascinating question, not something that kind of I've researched, but again, kind of to what degree does remote work or the ability to work remote kind of have a material impact on kind of financial results, on customer satisfaction? I think this is the type of question that for our job security kind of economists excel at answering, because it's not something you can A/B test. So I think this is going to be a rich area for research and employment for economists in the years ahead. So
Sure. So that's all the questions that I have. I don't see any other ones for from the audience. So I just wanted to take the time again to say thanks a bunch for coming to present to us again. I think this stuff that you guys are doing at Glassdoor, it's gonna be very important in sort of like the coming years as we analyze what a new normal is. Which I still feel like is a very open question. So there's a lot of interesting work that you guys have already done. I think going forward, there'll be a ton that you and your team will be able to tackle, and glad that somebody's out there getting sort of very detailed individual response data to try and answer some of the more pressing questions. But before we adjourn for today, just again to reiterate some of the announcements that I went over in the beginning, just because I know some people didn't joined a little later. the AEC is going to begin resuming their in-person meetings during the fall and the spring this year. It's not going to be every event, but we've committed to two in the fall, two in the spring. Again, the Federal Reserve really isn't back to normal, so it's not like we're going to be back in that glorious Fed building uh, uh, for lunch. But we will have our events in Cox in October, and then at Oglethorpe University. The Cox facility is also amazing. And again, some of our best events have been hosted at the Cox campus. Really looking forward to seeing everybody in person again. Tired of Zoom, just like I think everybody is. And again, like there's big benefits to being part of this economics club, and you can really get together and interact and network with the other members that are out there. So again, starting in October, that'll be our first in-person event. It's at Cox campus. There'll be an email out soon covering just sort of membership fees, what it's going to cost for the luncheons. We kind of have to get a handle of what food prices are these days, given all the inflation that's been going on lately. We'll try and keep it as reasonable as possible and cover our costs as well. So with that, again, thanks again, and I'll see you all next month.
Thank you, and thanks everyone for joining.